Okay, so welcome again, and we are beginning November 2019, question 4. November 2019, question 4. And the question says, the standard cost per unit of product J manufactured by Design Manufacturing Limited is provided below. We have direct materials, direct labor, variable overheads, fixed overheads, total production cost, startup profit, and selling price. Additional information is the actual data for the month of October 2019 was as follows. Opening stock, closing stock, sales, actual fixed overheads incurred amounted to 4,500,000. We are required to get income statement using marginal costing and absorption costing, and then we reconcile. So as we said, anytime you are dealing with anytime you are dealing with questions of absorption and marginal costing, you are supposed to begin by getting unit costs. By getting unit costs. By getting, Mohammed, I have written here, November 2019, question 4. That's the question we are dealing with. So unit costs, we start with the marginal, and we know that marginal, we always bring the variable. We always bring the variable. So the variable is 120. That is material, the variable production. Then we have 130 for labor. Then we have 130 for or 150 for overheads. So multiply, add those ones and give me the answer. Give me the answer for that. Yeah, good. I can see 400. The next thing is to bring absorption. Sorry, before we bring the absorption, we need to bring the FOER. We need to bring the FOER, the fixed overhead absorption rate. And that fixed overhead absorption rate, you can see it is 200. It is 200. It's 200. Then we bring the absorption. We bring the absorption. So for the absorption, it is 400 plus 200. So that one obviously will be 600. That one obviously will be 600. After that, the second thing that you are supposed to bring is the stock schedule. Is the stock schedule. And this stock schedule, we will have details here. And in the details, we begin with opening stock. You add production. You less sales so that you get closing stock. And then here we have units. Here we have units. So as you can see, the opening stock is 14,000. Production, we do not know, but we know that sales is 25,000. And then the closing stock is 12,500. So work out that and tell me what is the production quantity. What is the production quantity? Okay, according to Jamal, it is 23,500. 23,500. Someone else to confirm? Someone else to confirm? Okay, so I seek to proceed in the absence of confirmation or contestation. So let's start with marginal costing. Marginal costing, income statement. Marginal costing, income statement. Alfred is saying 1,500, Opio is saying 12,500. So what you're supposed to do, because we know this 25,000 was subtracted from something, so that we got this. You start by adding. You say 12,500 plus 25,000. So you add the two. Then you less this one that is already known. You less 14,000. That is how we are supposed to get 23,500. So I'll say you get it by adding these two, then you less the 14. So Simon and Alfred, are we okay now with that? Okay, good. So now we proceed. We start with the sales here. So sales, you can see the selling price is 750. So our sales are 25 times 750. If our statement is in thousands, Multiply that and give me the answer. 25 times 750. Yes, I can see 18,750. 18,750. Then you say less opening stock. So opening stock is 14 times, when we are marginal, 1 unit is valued at 400. So 14 times 400. 14 times 400. 5,600. 5,600. Then you bring production. Production is 23.5 times 400. 23.5 times 400. Yes, Simon, can see the figure. Paris, Mohammed, Alfred, 9,400. 9,400. Then closing stock. Now closing stock should be 12.5 times 400. 12.5 times 400 is 5,000. Good. So when we erase that way, we should get a figure called cost of sales. Give me the cost of sales. $10,000 according to our friends. Okay, Mohammed also 10,000. So these 10,000, subtract it now from the sales so that we have the gross contribution. The gross contribution will be how much? $87.50. $87.50. Now this question does not have the variable and production, so we just go straight to less fixed costs, and the fixed costs that we have are just the production. The production overheads, we are told the actual was 4,500. 4,500. So when you less that, what do you get? $42.50. That is net profit. That is net profit. Let us now proceed to do the absorption costing. Let us proceed from there and do absorption costing. Income statements. Absorption costing, income statements. So the absorption costing income statement, again, we begin with sales. And sales will be 25 times 750. This one remains 18,750. That one does not change. It remains 18,750. Then we say less opening stock. So the opening stock will be 14 times. Each unit is 600 now. So 14 times 600, what is the answer? 8,400. 8,400. Then we go to production. Production, you will say 23.5 times 600. 23.5 times 600. 600 is the value. That is the value per unit when you are in absorption costing. Okay. So 14,100. 14,100. So closing stock. Closing stock would be 12.5 times 600. Oh, 7,500. So when you do that, you get a figure we call the cost of sales. Give me the cost of sales. $15,000. So that 15,000, we are subtracting it from the sales. You subtract it from sales so that we get a figure called gross profit. We get a figure called gross profit. That 750. That 750. Then you say fixed overheads. Fixed overheads. So the fixed overheads, we have absorbed unachukua hizo ya 200 You multiply by the units produced. That is 23.5 times 200. 23, or is the one Jamal has already given me as 4,700. 4,700. Then you bring the actual. The actual is 4,500. You subtract. And when you subtract, you get a case of over. That's good, Jamal. That is over absorption. Over absorption of 200. And over is supposed to be added. So based on that, we have net profit of, is that 950? The net profit is that 950. Okay. So from there now, we do the reconciliation statements. Reconciliation statements. Reconciliation statements. So here we begin with marginal profits. We begin with marginal profits. So marginal profit was 4250. 4250. Then you less difference in opening stock. Difference in opening stock. So the opening stock, you can see these guys of marginal, they had 5,600. And these ones in absorption, they had 8,400. So the difference is how much? 2,800. Good. So this one you are supposed to less. Then you add difference in closing stock. So these ones, for their closing, they had used 5,000. Now they are closing, they used 7,500. So the difference is 2,500. So we are adding that. And if all is well, when you do that, you should get absorption profits. You should get absorption profit, which is that 950. Is that so? Are we getting that? Good. Alfred says yes. Okay, good to hear. So we should be okay with that. And now we proceed to question 5. The following information was extracted from the books of Imara Limited from the forecast made for the last 5 months of the year ended, that 1st of December 2018. So we have months, sales, purchases, overhead, depreciation, and wages. Additional information is that all purchases are on credit and suppliers are paid 2 months after the date of transaction. 25% of the sales are on credit. Debtors are expected to settle their accounts the month after which sales took place. Wages are paid in cash as they become due. The bank balance on 1st of October 2018 was estimated to be 3.6 million. Overheads are paid in the month in which they are incurred. Depreciation expense is included in the overheads provided above. You are therefore supposed to come up with a cash budget for the 4th quarter, showing the months of October, November, and December. So, that is November 2019. Question 5A, the cash budget. The cash budget. So I told you the first column is called details. And here, we begin with the receipts. Receipts, the items that are bringing money in. So for receipts, you can see according to information 2, we are told 25% of the sales are on credit. That tells you we have sales here. Some of them are cash, which are 75%. And then we have credit, which is 25%. And we are told debtors are expected to settle their accounts the month after which sales took place. There is nothing else that I can see given as a source of income. So if there is nothing else, that will give us what we call total receipts. total receipts, and we designate them as A, so that from there we do have payments. We do have payments. So for the payments, according to information 1, we have all parties are credit and suppliers are paid 2 months. So the first payment that we shall make is purchases. According to information 3, we are told wages are paid in cash and they become due. So we do have wages. We do have wages. Then we have overheads. We have overheads. And we are told these overheads, they include depreciation. So we will be dealing with the cash ones. We'll be dealing with the cash. That is the ones that do not have the depreciation. When we go back there, up there, I cannot see anything else. I cannot see anything else. And in the absence of anything else, I am able now to come quickly here and have a space for my total payments. Total payments. And this is B. Then thereafter, I have what we call balance. Balances. So in the balances, I have surplus, stroke deficit, and deficit is in brackets. And this one will be arrived at as A minus B is equals to C. Then I will bring the opening balance. The opening balance, we will call it D. And then I will have the closing balance, which will be C plus D. So now, I am told to do for the month of October, the month of November, and the month of December. The month of December. If you are finished drawing, I think I finished. Yeah, Vicky, Jamal. Okay, so all of us are finished. All of us are finished, so we can begin the work. So, for the sales, in October, they were 28,000. So 75% of 28,000 is 21,000. So naweka 21,000 there. The balance, tunaambiwa they are paid, they settle their accounts the month after which sales. So that means the balance of 7,000 will be paid the following month. Then we have 75% of that 2,000. That is 24,000. So 8,000 will be paid the following month. Then 75% of 38,000 is 28,500. 28,500. Then hapa in October, we are receiving 25% of the sales of September. So 25% of 26,000 is 6,500. 6,500. So when we add to 21,000, I have 27,500. I have that 1,000. I have that 6,500. That 6,500. Let us go to purchases. Purchases, we are told by information 1, they are paid 2 months after transaction. So that means what you bought in August will be paid after August, after September. So will be paid in October. So in October, we are paying for the purchases of August, which are 24,000. Then we pay for September here 25,000 and 14,000 and 14,000. Wages, we are told they are paid as they become due. So in October, we are paying 9,600, 12,000 and 12,000. Then for the overhead, we say it is cash. So you less depreciation. So for October, it will be that 600 minus 320. That is that 280. That 400 minus 320 is 3080. That 800 minus 320 is that 480. So you add 26,000. That gives us 29,480. 24,000 plus 9,600 plus that 280 is that 6,880. That 7,000 plus 3080 is 40,080. So 27,500 minus 36,880. We have minus 9380. That 1,000 minus 4080 is minus 9080. That 6,500 minus 29,480 is 7020. Opening balance, we are told it was 3,600. So if you say minus 9380 plus that 600, you will get minus 5780. So minus 5780 minus 9080. This is minus 14,860 minus 14,860. You add 720. You get minus 7840. So if you are okay with that, say okay. Mohammed is okay. Ferris, Alfred, Vicky. Simon. Yeah, Ben Jamal, good. So let us now proceed to the next question. So the question says, Baraka manufacturers operate separate financial accounts and cost accounts. The cost accountant maintains the cost ledgers, or the chief accountant maintains the financial ledgers. The financial accounting profit for the year ended was that, while the cost was that. You are told to do a reconciliation. So the question once again is November 2019, question 5B, and is profits reconciliation statement. Profits reconciliation statements. So as you know, we always begin with profit per cost books. Profit per cost books. We are told in the cost accounting, it was that 6,270,000. That is the profit per cost books. So we bring adjustments. We bring the adjustments. So the first thing is debenture interests. Debenture interests. Now, debenture interests is an item that is an expense which is already in finance. So the cost people never subtracted it, and therefore it is time to subtract. So 5,070,000. So that one we subtract. Rent of 97 was received. So rent received. So rent is an income and is only found in finance. So the cost people did not add it. So it is time to add it. 97.50. It is time to add it to the profits. Goodwill. Written off. Now the goodwill written off is an expense. Is an expense found in finance. So the cost people did not have the chance to subtract it. And the chance has come. We subtract because it's an expense. Machinery. Now that one we call it profit on machinery sale. And as you can see, that machinery was sold for 81,90,000. And the book value was 58.50. So what profit is that? What's the difference? $23.40, 2,340,000. So that one is a profit and is supposed to be added back. It's a profit and it's supposed to be added back. Notional rent. Notional rent. Now this one was charged in costs and it's an expense. So we are supposed to add it back because we subtracted, we should add it back. 54.60. Wanastahili warudishe because walikuwa wametoa. We have discounts around. Discounts around. Now, discount around is only found in finance and is an expense. So, the cost people need to subtract that. 27.30. When you give people discounts, your profits go down. So you're supposed to subtract. Then the opposite is true for discounts received. Discounts received. So the discount received is 19.50. So that one, you are supposed to add it back. When people give you a discount, it is good. It is an increase in profits. Then we have the overheads. Absorbed. So the overheads absorbed are in costs. Watu wa cost ndio huwa wanatoa. They subtract. So now that they subtracted, you need to add it back. Urudishe. So the 78 million should be added back. Should be added back. The overheads actual is what now should be subtracted. Now that we have returned back the absorbed, we should now subtract this one. 85,800. So that was a case of under absorption. And remember, you normally see under absorption is subtracted. It's the same thing we are doing there. Then we come to raw materials. Opening stock of raw materials. Opening stock of raw materials. Opening stock of raw materials. You can see this is 62.40. You less 81.90. Give me the difference. Is it 1950 or 1960? Oh, 1950. 1,950,000. Now, what you can see here is that the cost people had overstated. The cost people had overstated. And we said opening stock and profits, they move towards opposite directions. So when this was overstated, profit went down. So to bring it down, you are supposed to add. Bring it down, you are supposed to add. Then we proceed to opening stock. Opening stock or finished goods. Of finished goods. Opening stocks of finished goods. Again, we do the same thing. We have 18,330,000. You less 16,380,000. The difference between the two of them is oh, it's also 1950. Okay. So 1,950,000. And what you can see is that the cost people understated. So when you understate and it's opening, profit goes up. So to bring it down, you less. So this one we are supposed to subtract. We are supposed to subtract. Our closing stock of raw materials. Closing stock of raw materials. It is 10,530,000 minus 13,260,000. You mean 2730. 2,730,000. So you can see the cost people overstated. The cost people overstated. And I told you closing stock and profits, they move towards the same direction. They move towards the same direction. So if it was overstated, profit was also overstated. So to bring it down, you less. To bring it down, you less. Then closing stock of finished goods. Closing stock of finished goods. It is 15,210,000 minus 15,600,000. So give me the difference. 390,000. So once again, you can see the cost people overstated. They had a higher value. So the profit went up. So to bring them down, you need to less. So when you do that, I think we are through with all of them. And therefore now, we should get finance profits. The finance profits. Now the finance profit, as per the question, we are told it is 29,250,000. Check whether it agrees or whether it reconciles. You tell me yes or no. Okay, that is okay. So imekubali, good. So if it's okay, that is good. Let us now proceed to the paper of May 2019. Okay. Question 1, describe 4 characteristics of a good remuneration system. So May 2019. Question 1. So that is question 1A is asking characters of a good remuneration system. Characters of a good remuneration system. So this one I gave you very many, but number one, it should be very simple to understand. And compute earnings. It should be very simple to understand it and also compute your earnings. Number two, earnings should not be affected by factors beyond control of the worker. Earnings should not be affected by factors which are beyond control of the worker. It should satisfy the needs of both the employer and the employee. It should satisfy the needs of both the employer and the employee. It should provide the right quantity and quality of workers. Quality of workers. Another one, it should have guaranteed minimum pay. Guaranteed minimum pay as number 5. Number 6, flexible to accommodate changes. To accommodate changes. It's flexible to accommodate changes. Another one is compliance with legal requirements. Compliance with legal requirements. Those are the characters that should be there. So those are some of the characters. If you are finished writing, send my finish. Vicky has finished. Alfred. Simon Mohammed. So now waiting for Jamal. Good. So the next one is BD Enterprises applies an incentive scheme of labor remuneration. The following data is provided. Time around per unit, units produced, time taken, basic pay, rejected units. Bonus is paid at 50% of normal wage rate. No penalty is imposed. For each of the above, determine those things. So once again, the question is May 2019. Question 1B, and is about computation of earnings. It's about computation of earnings. Computation of earnings. So we have details here. The first person is called Jane. The next one is called Peter. This other one is called Anne. So the first thing is to get the hours. That will be the first thing, is to get the hours or time. And the first one is around the time that has been around. So for Jane, itakuwa a quarter times the number of units, 474. So give me that. A quarter of 474 is how many hours? $118.5. 118.5. When you go to Peter, it is a sixth of 684. A sixth of 684. Is 114. When you go to an, is a half of 175 units. A half of 175, 87.5. That is the hours that have been around. So the next one is you bring the hours taken. The hours taken. So the taken, they are provided already. So this is 78. This is 72. And this is 80. Those ones are already provided. The next one is saved. So if maybe I may call this one A and this one I call it B. Then saved will be A minus B and you call it C. So here I'll be talking of 118.5 minus 78. Those will be how many hours? $40.5. Then 114 minus 72. $42. 87.5 minus 80. $7.5. So this question has not informed us of the it has not informed us of the basic pay, sorry, of the basic hours. So those ones we just ignore them. And that's the end of the part for the hours. The part for the hours inaishia hapo. So let us now come to the pay. the pay in shillings. The pay in shillings. Let's start with bonus. So bonus, we are told, is 50% of the so let's call it D. It is 50% of the normal wage rate. So utakuwa nasema 50% times the basic wage rate of Jane is 600 times the number of hours saved, 40.5. 40.5. Give me that. 12,150. Then we do the same thing. 0.5 of 600 times the hours saved, 42. 40. 12,600. 0.5 times 300 times 7.5. 1125. 1125. Let us now compute something else called basic pay. And we call it E. The basic pay, you take the basic rate, 600, you multiply by the time taken. So 600 times 78. 46,800. We begin at 600 times 72. 600 times 72. 43,200. Then 300 times 80. 24,000. Then you come and get the gross pay. Now the gross pay will be B plus E. You can call it F. So 12,150 plus 46,800. 12,150 plus 46,800. $58,950. 12,600 plus 43,200. Or 55,800. 11,25. plus 24 hours. $25, $125. Then per unit made. Per unit made. So per unit made utakuwa unasema ni 58 950. You divide by this person. Oh, it is per unit made, not per the good unit. So divide by 474. Mohammed, we will not subtract because the question says per unit made, not per good unit. Wage cost per unit made. So 124.37. Then 55,800. You divide by 684. So Jamal, are you still giving the same figure? 58, 950 divided by only 474, not 475. 474. It is 124.37. So it's okay. Oh, ama unapeana ile ingine 55,800 divided by 684. Hapana. So Jamal and Opio, sijui kwa nini mnapata 0.1. The correct answer is this one. So the second one, 81.57. Should be 58. 81.58. Oh, so rectify, that was a mistake, supposed to be 4. And then this other one, 25, 125, you divide by 175. Okay. You divide by 175. What do you get? No, 143.57. 143.57. 143.57. 143.57. Okay, that one we are done. And therefore we proceed to the next question. Distinguish between period cost and irrelevant costs. Period costs and irrelevant costs. So write this. Write this. Period costs. Period costs are costs that belong to a particular period. To a particular period. And are fully written off. And they are fully written off in the income statement of that period. They are fully written off in the income statement of that period. That is, they are never carried forward. They are never carried forward. They are never carried forward. The next one, irrelevant costs. Irrelevant costs are costs which do not have the ability. Are costs which do not have the ability. Are costs which do not have the ability to influence a decision. They are costs which do not have the ability to influence a decision. Do not have the ability to influence a decision. Okay, let us proceed to the next part, which says AMC Limited manufactures three products, namely A, B, and C. The processes by which they are manufactured are independent of one another, and the sales of one product are in no way affected by the prices or volume of sales of the other products. The company's budget income statement is as follows. So we have that. Advise the management on whether product B should be discontinued. Advise on whether we should discontinue. Just a minute. I make a small adjustment here. Trying to run away from this reflection. This one. Okay, so this question, so the question is on, that is May 2019. May 2019, question 2B is drop or retain decision. So in this one of drop or retain, in this question of drop or retain, the question is whether we should drop so my figures are thousands. So if we have it that way, we have details here. Then retain product B, retain product B, or drop product B. Retain product B or drop it. So if we decide to, or rather, what will happen? We will have sales. So if we are retaining, I told you everything remains. So we will have 30 plus 20 plus 150. How much is that? How much is that? Yeah, it's 200. But if we drop B, we will have 30 plus 150, which is 180. We will have 180. Then we say tunaweza hata ipanga tu the same way wamepanga. Let's arrange it the same way. Production costs, we have the variable. So the variable, it will be 16 plus 8 plus 96. Give me that. Sixteen plus 8 plus 96. Is 120. But on this other side, I will have 16 plus 96. That is 112. That is 112. Then from there, I have the fixed. Now the fixed is 2 plus 6 plus that 2. 2 plus 6 plus that 2 gives us what? $40. But when you drop, the fixed cost will not change. So we will still have 2 plus 6 plus that 2 being 40. So from there, we have gross profit. Gross profit. So give me the gross profit. For the first one, what is the gross profit? $40. The second one, what is the gross profit? The second one, $28. Then after the gross profit, we bring selling costs. Selling costs, First of all, we have the variable. Variable is 5.4 plus 5.2 plus 5.4. That would be how much? That is 16. Then on this side, we will have 5.4 plus 5.4. That must be 10.8. Because the one for B will disappear. Then fixed. Fixed, I have 1.4 plus 1.4 plus 1.2. That would be how much? Yeah, that would be 4. Then these will still remain. The fixed cost does not change. The fixed cost does not change. So based on that, tell me what would be the profits, net profits. Ya kwanza, net profit is what? 20. The next one, what is the net profit? 13.2. So what do you advise? What do you advise? Should we drop or we should retain? Yeah, good. Mohammed, we should retain. Product B, since we will get a higher profit. We should retain that product because we shall get a higher profit. And quickly, now the time imeisha, but maybe quickly we can finish part C. Part C of the same question. The question is on inventory controls, specifically EOQ. Inventory is the other word for material costs. So we are told to get the total annual. So the first thing is to get economic order quantity. Economic order quantity. Now the economic order quantity, EOQ, is given as 2RS. You divide by CI. You get the square root. You get the square root. So we are told Cornell has weekly demand of, so our R will be per week is 16 units. And we are told we have 50 weeks. So how many units are those? 16 times 50. Those are 800 units, please. 800 units. Then S, the fixed cost per order, we are told it is shillings 4,400. C, cost per unit is shillings 55. And then I, the cost of capital, is 20%. And therefore, EOQ should be 2 times 800 times 4,400. 4,400. You divide all this by 55 times 0.2 times 0.2. So give me that. One 160 units. One 160 units. Then we come and get the costs. So for the costs, we begin with purchase. Purchase is given as R times C. So this will be 800 times 55. Purchase is given as 8R times C. So 800 times 55 is how much? 44,000. Now, where are we saying it is 800? The EOQ, this one. This is the one you're saying is 800. Okay, so then, meanwhile, this one is given as 44,000. Confirmed. I only have Alfred giving the figure. The others, is that confirmed? Mohammed. Is that figure confirmed? 44,000. Good. Let's go to ordering. Now, ordering is supposed to be given as R. You divide by Q. You multiply by S. So it is 800. You divide by 800. You multiply by S, which is 4,400. And these obviously should be 4,400. 4,400. Then you come and get the holding. Now holding is Q, you divide by 2, multiply by CI. Q divided by 2, multiplied by CI. So Q is 800, you divide it by 2. Then you multiply by 55, you multiply by 0.2. You multiply by 0.2. So you get how much? $4,400 again. So if that is confirmed, then my total should be 44,000 plus 4,400 plus 4,400. So that should give us a total of what? 52,800. 52,800. Good. So we stop there for today. We will pick up from there in the next lesson. We'll pick up from there in the next lesson. So I think you are okay. Is that so? Good. So have a nice time until we meet. Oh, still copying? Opio. When you finish, let me know so that I can end the session for the purposes of recording. Opio, have you finished? Okay, Alfred, have you finished copying? Alfred. Okay, good. So thank you so much. Have a good day.